Let's get started. Okay. Well, you need obviously a basic introduction to finance. Finance is the subject of money. Financial means, well, let's use an equal sign. Money. Financial management is the same as money management. So, financial management is the art, the subject, the science, or the practice of managing money. Okay. Now, finance in general has a lot of fields. At the very root of finance is money and banking. I am teaching now a course in money and banking. You're more than welcome to come enroll and understand what money and what banking is, commercial banking. So, banking includes commercial and central banking. Okay, how a central bank manages money and credit in the economy. The next little subfield of finance is actually financial economics. And financial economics includes actually money and banking. That's one little subject. The really big subject is financial markets and institutions. So, this is the so-called, as I wrote it up there, the financial environment, how businesses operate. What is the financial, how banks operate, how mutual funds, hedge funds, all the different types of financial institutions. You also study financial instruments. And again, I will be explaining a little bit of this in chapter 2. That will be the next chapter. I'll be explaining and giving you the basics about this. Okay, so that's financial economics, and later on, for those of you who choose, there is a full, complete course on financial markets and institutions that you can take if you decide. So, finance, next one is financial management. Financial management is considered to be the foundation course of all finance courses. So this here is mostly financial economics. It is the field between economics and between finance. It's in between. That's where I started early on 15 years ago teaching and doing stuff. Financial management is considered pure finance. Next one will be investments. Investments is basically the subject of how to make money from money. Okay? How you invest, if you have money, to make more money. Okay? Banking is a little bit similar, but you don't have money. Use people's money, use depositors' money, and make loans, okay? And we'll be explaining some of these differences later on. Now, we get to, and it's a forgotten subject back in the old days, finance originated as a subject and originated as a field, as in public finance. Public finance is the subject of how government manages its own money. And public finance is associated with taxes, as in government taxes. Government taxes will represent revenue for the government. Government expenditures, this is what government spends money on. Governments usually spend money mostly on themselves, okay? And most of the money follows and flows through into corruption, okay? And the last piece here is the government debt and deficit. Deficit represents the difference between what the government gets and what the government spends, okay? Usually governments spend a lot more, and they usually borrow and buy debt. So that's public finance. Another subject which is not really very well taught, and again, I don't understand why, there's actually a good reason, is governments, academia, they want people to be ignorant about their own finances. So there is a special subject, personal finance, about how a household, how a family should manage its own finances. But in America, they don't want a family to manage its own finances. They don't want a family to be relatively wealthy. They want the family to borrow money and buy a car. They want a family to borrow money and buy a house. They want people to be in debt. You don't want people to be knowledgeable, competent, and understand their own money, okay? The less people understand about their money, the more the government, finance, bankers can take from their money. A good saying is that a fool and his money soon, soon set apart. Meaning that usually people who are not smart about money, they usually lose most or all of their money. So personal finance is a subject which is pretty much not taught anywhere. You know, they don't want people to learn and understand about managing their own finances, about not using credit cards, about understanding how extremely expensive credit cards are, and all the other sort of consumer finance and consumer finance lending. They don't want people to understand that the best way is not to be in debt. You don't borrow money in the first place. You don't pay interest. If you're smart, you collect interest. You're not paying it. Anyway, so personal finance is an important subject. And now comes the hardest of all finance subjects, the most difficult, the most comprehensive, and it covers all of these at the same time. It relies to money, to banking, to all financial institutions and everything, and that's risk management. Risk management can apply to managing the risk, financial risk of a family. It may apply managing the financial risk of the government finances. It can apply to managing the risk of your investments, as in your stocks, bonds, real estate, whatever, gold, whatever you invest in. It applies to managing the financial risks of a company and corporation. Okay, and it applies to managing financial risks for all financial institutions. Mutual funds, pension funds, hedge funds, okay, insurance companies. So risk management is by far the most difficult of all subjects. Now, a lot newer subjects in finance will be financial derivatives. And a derivative is an instrument, financial instrument, that derives its value from some other financial instrument. This is very complex, very difficult, very advanced. Usually taught in the last year of any finance courses. And the typical name that you will see associated with it will be futures, options, and swaps. Okay, so this is very complex stuff. So in this course, we'll be essentially focused in this little world, and in this course, we'll actually focus on the first half of that little thing. Alright, let's get back on with chapter 1, which is getting started, and see how far we can go today. Later on, you can remind me to take another little break. So, with this introduction to finance, moving on to chapter 1. Getting started is the same as introduction. So, what's the introduction? Section 1. So, you got these little sections. Section 1. Section 1 is finance. Finance. Overview. Well, I already did make an introduction to the field of finance. So, they like to do this to fool people by telling you that, oh, this is finance. No, this is financial management. Financial management is a tiny little piece of finance. So they are misleading people into doing the following, into thinking, so what is finance about? And again, this is not about finance. Let me rewrite this whole thing because it's incorrect. It's financial management. So, number 1, financial management is about red color work. Capital. Budgeting. All right. First, budget means a financial plan. So, it's about financial planning. Capital, capital is by far the most difficult concept in finance. Capital is certainly the most confusing concept in finance. Pay attention, because it has 5 completely different meanings. They mean all sorts of things to other different people. So capital can mean equity, as in owner's equity, money that people have invested. But it can also mean long-term Here in capital budgeting, it means long-term assets. It means machines, equipment, real estate. In other words, assets that you will use it many times over a long period of time. Printers, computers, cameras, all sorts of equipment. Long-term assets would even be tables, okay? So any asset that you typically use over more than 1 year. So capital budgeting, let's try and get something, is how to invest properly in your assets. Which assets to buy, which long-term assets to buy, and which of them are most profitable. So this is, should we buy a laptop or should we buy a computer? Should we buy a small car or should we buy a big car? Should we buy a minivan? Should we buy an SUV or should we buy a bus? Okay, so this is capital budgeting. Next, number 2 is capital structure. Here, again, the most confusing word in all of finance is the word capital. Means, let's do this. Financing. Financing means how to finance the company. How much debt and how much equity. How much debt, which is borrowing, and how much equity. Equity stands short for owner's equity. And again, the same confusing thing. This equity is, that's the meaning of, second meaning of capital. Okay. So the structure essentially means, should we use a lot of our own capital, meaning owner's equity, or should we borrow? How much to borrow? What is the best mix, the best mixture between these two? Is there such a thing as, and that's a question we'll try to answer maybe next semester, optimal capital structure? Is it optimal? What's optimal? Is it optimal to borrow 50% or 80% or 20%? Or is it optimal not to borrow at all? Okay. So now I have to consider the benefits of debt versus the cost of debt and the risk of having debt. And number 3 will be, right again, working capital. Working capital. And sometimes they call it working capital management. Working capital are the short-term assets of the company. If you're selling food, whatever the food products are. Working capital are all those little things that you normally use in the course of a business. So, the big difference between working capital and this type of capital is these are long-term assets. you use it over and over and over again. And in the working capital, you use it one time and then it's finished, it's used up. So short-term things like paper. So the printer, copier will be a long-term asset. The paper that we use is a short-term, it's a working capital, okay? The markers we usually use and throw, it's a working capital, okay? So all of those things that we use temporarily and they get used up. You can't use over and over and over again for many years. Okay, so that's number one. Let's see what else. So, we had 1.1 is basically what is financial management. Section 1.2, that's on again, page 12. Section 2, why? Why study finance? Well, in general, it's good for you. It's good for you to understand general finance. If you understand general finance, there's a chance you better manage your own personal finances. You better be able to evaluate, is this mortgage better or is that mortgage better? You have a better chance of managing your own business. You better have a better chance of understanding how business world works and operates. So there is a general overall benefit to understanding the world of money. Okay, that's very straightforward. Let's see. You will be also better able to understand financial markets. What is the financial market? What does it mean, the currency falls or whatever the problems are? All right. 2 is the 3 types of businesses. So, types of business organization. That's page 13. Number 1 is sole All right, guys, enough talking, okay? So now I have to separate you, move you up front or out. So proprietorship, this is a company owned by one single person. That person is the owner and he is responsible for the liabilities of the business with his own assets, okay? So he is personally liable. One of the key words in general is to be liable. Liable means responsible. Responsible if a death occurs, responsible for debt, responsible for borrowing. So, if you're a sole proprietor and you can't pay your bank loan, the bank can come and get your car, they can get your house. So that's a fairly risky proposition overall. So the key is, he is personally responsible for all the debt of his business, of his proprietorship. That's the key. There is no separation between the owner's finances and his family or household finances. Number 2. Partnership. And partnership is now 2, 3, or more people join together to have their own business. With general partnership, so you can use in here general, they are all responsible for the debts and obligations of the business. So, if the 2 of you got your own business and the business gets in trouble, they'll try to get your house, and if it's not enough, they'll get your house too. They're going to get both of your houses. That's what the banks are for. That's why you want to work in the bank. You want to get the house, not have your house taken from you, right? That's why people want to work in the bank, right? All right, so that's the general partnership. And the other one is going to be called limited. And a limited partnership will actually be able to separate their own finances from that of the firm. There is also a possibility, and it's very likely, that when I have a large partnership, let's say 6 or 10 or 20 people, some partners will be general. They will be fully responsible for the company's operation, for the company's management, and if things go wrong, the bank can take their money. And at the same time, you may have some limited partners. They put in their capital, they put in 10,000 into the business, and if things go wrong, you can't get any more money than that. In other words, in a limited partnership, all you can lose is your initial investment, what you invested in the business in the first place. That's the key here. And number 3, it's the big one, is corporation. Let's see what we got on corporation. Well, corporation will have shares. And a share represents a unit of ownership in the corporation. And a person who owns a share is called a shareholder. And shares are called stock. Stock. Some people think or say that shares will be mostly British. Your share is 3%, 5%. And some people say that stock is mostly American, US usage. Either way, today in the modern world of finance, they're all used equally, and share and stock is the same. So become a stock holder. Stockholders, again, will be owners of stock of a particular company, so they will be part owners. If there are 1 million shares and you own 1,000 shares of those 1 million, you own 1,000th of a company, and 1,000 of a company is 0.1%. Okay. Let's see some of the characteristics. Well, the big characteristic of a corporation is, I already wrote it there, we'll write it again with red. Limited liability. The stockholder, the investor, does not owe and cannot lose any more than his original investment. If you put in 5,000 to buy the stock, 5,000 is the maximum that you can lose. That's limited liability. You can't lose more than that. So, a lot of investors would like to choose corporations because they have a limited liability. You can make your money 2 times, 3 times, 10 times, 100 times, but you can lose at most what you invested originally. So that's number 1. A second very important characteristic of corporation is indefinite life. Here, the life of a proprietorship is associated with the owner himself. When the owner dies, the business dies, okay? The proprietorship dies. Maybe someone else will inherit it or not, but overall, the life of the business is associated with the life of the sole proprietor or with the life of the partners, okay? Here, it's an indefinite life. Another important characteristic for corporation is professional management. You may own a restaurant over here as a sole proprietor, and again, you may know how to manage a business or not to manage a business. Usually, again, this is just research and that's how it's advertised. 80% of businesses, of small sole proprietorship businesses, fail because the owners don't understand basic accounting and basic finance. They can't manage their own money. They don't know how to handle money. They don't understand how to invest in their own business. And of course, they don't know how to manage their own business. But they usually fail to manage their own business because they don't know how to manage the money and finance. If you got your own restaurant, you can manage the cooking, that's fine. And you can manage the 5 tables and maybe the customers as they come in. But people fail on the financial and accounting side. So having a professional manager could be very helpful, especially for a relatively large business. Again, if you just have one little restaurant with 4 tables and maybe 3-5 customers at the same time, maybe today you're going to have 50 customers, it's not a big deal. But having a professional management is important for a relatively large business. Let's see what else we got here. Oh, another characteristic, I will not spend much or any time in this course much about it, is double taxation. Taxation is specific to the country. In Bulgaria, it is one type of taxation. In Thailand is a different. In the US, in the UK, in Japan, in every little country or big country, taxation is different from any other. So there is no point for me to teach you about taxation because you, me, we don't know which environment you're going to run in, where you're going to operate. And you can study taxation now. Within 3 or 7 years, your taxes will change. There's no point in learning and spending and wasting money on taxation. Nevertheless, in most countries around the world, corporations are taxed twice. The first time they tax the corporation. The corporation has a profit, it's got an income, and if it has a positive income, meaning a profit, the profit will be taxed, called profit tax, income tax. And then a second time, when the corporation pays to the owner, a payment to the owner is called a dividend. So dividend is a payment by a corporation or by a business to the owner. You should have studied this in accounting. The dividend is taxed separate. So you got corporate tax and then you got the individual tax. That's a major disadvantage to be taxed twice. Now, the limited liability is a major advantage. The indefinite life is a major advantage to a corporation. Professional management is usually a major advantage. And double taxation is a disadvantage. Having shareholders is actually an advantage in the following sense. in the following sense. Shares are traded on the market. So there's stock market. Stock market, let's call it liquidity. Liquidity means ability to convert to cash quickly. So, if you're a shareholder, you own shares, you can sell quickly to the stock market and get cash quickly. If you're a sole proprietor, you can't sell your business quickly. You might not be able to find a buyer for a restaurant. But if you want to buy stock of Intel or Apple or Samsung or whatever your favorite company is, Kia, of course, Lexus, right? You can go and you can just buy shares, 1, 2, 10, as many as you like. And whenever you like, you can sell those shares quickly. So the advantage of the shares is that you can buy as many as you want, whenever you want, whenever the stock market is open, and you can sell as many as you want, as long as the stock market is open. It may be hard to sell on a Sunday when the stock market is closed, but on Monday you could do that and get your cash quickly. All right, let's see what else we got. I got this part, I got this part. Okay, well, that's next, let's see, what's the next section? Partner, okay, that's all right. All right, next little section, I kind of mixed up the sections for some reason. So this partnership is on page 14. Okay. The corporation is on page 15. And now on page 16, all right, over here is section 2, 4, and I'll take a break after this one, not now, after this one, is how does finance fit into, okay, organizational structure. All right, let's get a little bit about your own business students. Is there any finance student here? Anybody in finance? Oh, quite a few. All right, for all of you who study business, the main areas, the main fields of business are marketing, management, accounting, finance, and number 5 will be maybe production, if you have production, maybe operations. And usually production and operations will fall within management. Anyway, so that's a fairly straightforward areas. We call these functional areas. Now, in terms of corporation, at the very top is called Board of Directors. The Board of Directors will be selected by the stockholders. In other words, the owners will choose or select the Board of Directors to represent them. Now, the Board of Directors will choose or select the CEO. They will hire the CEO. That's the Chief Executive Officer. That's the one person responsible for all operations of the business. And he makes all decisions except for strategic, the big decisions. The big decisions are made by the Board of Directors. Now, under CEO, you will have VP Marketing. You will have VP Management. And you're going to have VP Accounting and Finance. So here you're going to have accounting and finance. You may have many others, okay? But here we focus on accounting, okay? The accounting department will have, and finance in general will have, controller. And treasurer. So these will be run by a controller, and the finance department will be run by a treasurer. Let's see now where I'm going to go with this. I just want to finish this. All right, so let's do this here. That's on page 16. And let's see what the treasurer is responsible for. Well, number one, remember these guys are managers. So it's about cash management. The treasurer, you must manage cash. He must raise cash. Managing cash means you got a lot of money, you got a lot of extra money. When you have more money, what to do with it? Raising cash is you need money, you don't have enough money. You need to get some, how to get it. Raising cash is the decision of how to get cash. Related to raising cash, which is more or less the same, is borrowing. Let's call it credit. Credit is in borrowing. This is G over here. And whether to borrow long term, whether to borrow short term, do you borrow for 6 months, do you borrow for 2 years, how to borrow, terms of credit, under what conditions. Let's see. The general, very, very big field of is capital budgeting. This is, let me move back over here, the same capital budgeting as this one. Do we buy a truck or an SUV? Okay. Do we buy a bus or whatever? Good. Capital budgeting. And let's see what else. Yeah, in general, with the capital budgeting, but it's a little separate. Capital budgeting refers mostly to long-term assets. Here, we got the general thing of financial planning. And there will be a chapter down the road on how to make a financial planning, which is the same as budgeting. And you have to make difference between budgeting and capital budgeting. Capital budgeting refers only to long-term assets, machines and equipment, real estate. And let's see anything else. Cash, credit, capital, expenditures, raising capital. So this is how to raise cash. But it's different from raising capital. How to raise capital. Today, Deutsche Bank is in a big trouble. It's the biggest bank in the world, or one of the biggest banks in the world. It's the biggest European bank in the world. There are a few others. And they are technically insolvent. They're kind of like bankrupt, okay? So they need to raise some capital, and they got to figure out how to do without damaging their current shareholders and all sorts of other stuff. Anyway, how to raise capital is an important consideration. And last one is Forex. Forex. Okay? Managing foreign exchange, which is the same as managing foreign currencies. It's the same thing. If you got extra foreign currency, what to do with it? Do you convert it? Do you keep it? Where you keep it? Or if you will need a foreign currency, you'll be importing from Japan, you got to pay to the Japanese in yen. How and where you're going to get the Japanese yen to make a payment. And let's control. One of them is just accounting. Another one is taxes. Accounting is fairly complicated, okay? Again, with an accounting will be financial accounting as in financial reporting. The other one within accounting is managerial. Managerial. Reporting. Okay, and there's one last thing. Will be cost and data processing. Cost processing. In other words, he'll make payments of salaries, maybe in cash, maybe he'll transfer the money to the bank, okay? So they'll make some basic payments and stuff like that. So that's a small difference between controller and treasurer. What you study in accounting applies mostly to the functions of a controller, and what you study in financial management applies mostly to the treasurer. One last minute to get a break is the following. Essay questions, meaning what kind of questions you may get so far for the quiz number 1, maybe in week 3 or in week 4 is, well, describe the types of business organizations and the advantages and disadvantages of a corporation. That's a simple question. Another one, what are the 3 main areas? Describe and define the 3 main areas of finance, financial management. Another one will be, what are the primary responsibilities of a treasurer and of a controller? Okay, so you need to provide a simple definition and a description. All right, take about 5-10 minute break, and then we continue with section 3 and section 4. Cameron?